What's up, guys? Welcome back to the Real Estate Momentum Podcast. I got my boy Charlie Vallandingham here with me with Heritage Bank. And today's podcast, I kind of feel like it's sponsored by the Trax Fitness Lab because look at us. I mean, we've been in the gym. Flex on them, Charlie. See what you got. Look at this guy. It's the Trax Fitness Lab. I mean, it's legit. You know, we're in our mid-30s, 40 years old.
Pushing 40.
And we got the energy. It's just, we're having fun. So Charlie and I, we talk a lot in the gym about mortgage, which is what he does on a daily basis in real estate. We're out here in the real estate market. And I wanted to give Charlie, time on the podcast to share with you guys what he's been sharing with me on what they're doing over there at Heritage Bank. So we're going to start from the beginning, which is a good place to start on the mortgage process here. But I guess first, tell us a little bit about yourself briefly on how long you've been doing this, and I guess you've been through good times and bad in the real estate world, right?
I have. And first and foremost, thank you for having me.
Yeah.
Thank you, Mr. Platt, for letting me use your space here.
Deep Work Studios, baby.
Deep work. Yeah, so again, my name is Charlie. I do work for Heritage Bank. I've been with Heritage for 2.5 years, approximately. I've been in the mortgage business going into my 12th year. I'm actually in my 12th year from March. So I have seen a little bit of highs and a little bit of lows.
So you got started in 2010 when 2011. Okay, so the mortgage industry had kind of imploded a little bit.
Mm-hmm. I started in a refi shop, and I was just calling people trigger leads all day long.
Really? Mm-hmm. So lead would pop up from some website, and then you'd call them to see about refinancing their house. Do they qualify? Do they not? That sort of thing.
That's correct. In the company I worked for, great place. Learned a lot of sales tactics with them. We had a full script, I'm sure, like a lot of sales agencies do. And it was overwhelming at times. You know, you're going after people that are really in a bad financial situation. And back then, I didn't know the ins and outs of how it could benefit. It was more or less get them to do the deal.
Gotcha.
So things have changed.
And I feel like our industry, mortgage and real estate, has gotten a lot more relationship-based lately. And it's more close ties with the client as opposed to let's just bang through a bunch of transactions and make as much money as we can. It's more, how can I help you so that you see value and you tell your friends and family about it?
That's correct. And it was very transactional back then. And then, fast forward a couple of years, I got into the purchase market. A former partner of mine, still a great friend of mine, and he taught me everything I needed to know about the purchase side of things, and it was a totally different ballgame.
Yeah.
So that was getting out there, shaking hands, meeting people, networking, doing the things that we all love in real estate, and really changed the game for me. It really kind of opened it up, and is what really made me fall in love with it.
Well, and I feel like when you hit that 10-year mark, it's like, okay, I've seen the good, bad, and the ugly. I've got some confidence about what I'm doing now. People can trust me and that sort of thing. It's just a checkpoint.
That's right. That's
right. So what you guys don't know is that Charlie was it a refi? Did we cash out refi?
Yes, one of
so
your investments.
Charlie just did a mortgage for me and my family on one of our rental properties, and we pulled out money so that we could use it to buy more investment. And the process was ridiculously smooth. The communication was top notch. Charlie's got a good team around him that keep you posted all along the way. And I kept apologizing to Charlie because it's like there's
two types of buyers.
Yeah, Charlie's like there's two types of buyers. There's people who have all of their documents ready to go, ready to send you, and then there's buyers who you kind of have to bug them. And I was somewhere in between, but I feel like he had to bug me a little bit, being self-employed, and we'll talk about that too, what that means. So. But you guys were great, and that's why we're about to open up this can of worms called the mortgage process so that people who are, spending time watching this can figure out, okay, how is the mortgage industry right now and what do I need to be prepared for, right?
Yeah, absolutely.
So kind of, let's just say, for example, I'm your buyer. I'm your borrower. My real estate agent said, hey, call Charlie. He's a great loan officer here at Heritage Bank. And then I call you, we set up a meeting, and I can either come into your office or we can do this over the phone. For the sake of argument, we're here together. Let's just say that I'm in your office right now.
Yeah,
cool?
Absolutely. And typically, I'd say probably 40% of the people that I talk to would like to meet in face, face-to-face, or we set up a lunch or whatever it is, just to make it more comfortable for however it goes. This time last year when refis were crazy and the purchase market was blowing up like it was almost always over the phone. So there's different ways to go about it, but typically the first thing I ask someone that's a first-time buyer is, okay, what brought you here?
Okay.
So typically they're gonna tell me like, hey, well, we know it's time, we're getting married, we're about to have a family, whatever it might be. So let's look at buying a house. But they don't have the first clue about how to go about it.
So when I'm a buyer and I'm a first timer, right? I've never done this before. I walk into your office. What are some misconceptions that I might walk in with right away?
Immediately that you have to have 20% down.
Yep.
That's probably the number one. There's so many different products out there. We can go as low as 3% down, sometimes even 100% financing, whether it be a USDA property, depending geographically where it's at. If they're a veteran, always going to look at a VA loan first and foremost if they're a veteran. And if it makes sense, then we're going to look at that route. My very first question that I ask people, especially couples or even a single person, is what's your budget?
Okay.
What do you plan on spending for a mortgage, taxes, and insurance on your property?
Yeah. What all in every month? What do you like? Where do you want to be?
All in every month.
Yep.
And most people are like, well, I don't even know. I'm like, okay, so what's your rent?
Okay.
My rent's $1,500. Okay, are you comfortable with paying that? You want to go a little higher? Would you rather be lower? Almost 9 times out of 10, they're going to say lower.
Yeah.
Of course, but realistically, it doesn't really happen very often. So that in mind, the reason I ask that is because I can backtrack and build a loan around that budget. Because most people want to be qualified for as much as they can. Mm-hmm. I can almost always qualify people for much more than they're able to pay back.
I hear that so much. Like I was on a showing with a buyer who had recently been pre-approved, and they're like, man, like when that loan officer told us what we could afford, like we were shocked.
Yeah.
And I said, well, when interest rates are 3%, and they're looking at your debt to income ratio, like your comfort zone might be 300, mm-hmm. and they might tell you can spend 700. It's like, just because you can doesn't mean you should. So I like the way that you do it. It's like, hey, where's your comfort zone? Let me see if I can make that happen for you. Mm-hmm. And then, you'll probably let them know if they got some wiggle room there, right?
Oh, yeah, absolutely. And, a big misconception is we qualify off gross income. So if you're making $50,000 a year, we're taking that over 12 months, and that's what we're qualifying. We're not taking Uncle Sam's cut. We're not talking about your utilities. We're not talking about trash. We're not talking about any of that. So you take away that, it's a significant amount, and people are like, well, I don't know if I can actually afford that in my budget now.
Right.
Yeah.
So the first question you're asking me is, what's my budget? Mm-hmm. And, I say, okay, my rent's $1,500 a month, and, I'm comfortable there. I've got a little extra play money there, so if we need to go $1,600 a month or a little higher, that's fine too. Then what?
Next question is where you want to be geographically.
Okay.
What type of house do you envision yourself living in?
Why is that important? Why is where I live important to you?
Tax rate.
Okay.
So if you want to live in Fort Mitchell, all right, we got another conversation to talk about versus Independence, Florence.
Yep.
The tax rates are different.
So
Campbell County is higher.
Campbell County, I just found this out, is one of the highest tax rates in the entire state of Kentucky.
Really?
Yep. I think
it was high around here, but
yeah, Campbell County's got high taxes, and there's certain parts, and they're not super high. I mean, there's like Cincinnati's taxes. In Ohio, Cincinnati's taxes are higher than anything we've got here in Northern Kentucky.
That's right.
But relative to Northern Kentucky, Boone County's taxes are cheaper, Campbell County's taxes are higher, Kenton County falls somewhere in between.
That's right.
Right? So just kind of going back to the point of, like, why is it important on where they want to be?
Yeah, and again, geographically, I get a lot of people from Northern Kentucky. A lot of the bank clients that I do work with are typically Boone, Kenton, Campbell. My personal clients, referral partners. I see a lot of Cincinnati too because I do cover the Cincinnati region for the bank. So, the Mason area, that's a high tax bracket as well. Montgomery, same thing. So there's different little pockets. That's why I asked that question, just, the affordability and the buyer's ability to, 200 to 250 could simply be for the tax bracket.
So then you say, what kind of house am I looking for? Why is that important?
They want a condo.
Yeah. H.O.A. fees add up.
Yeah, exactly. Well, that's another thing. If they are looking at a condo, that very simplistic style of living, don't have to mow the grass, whatever else, HOA fees are out off the chain these days.
Yeah.
Anywhere between, what I've seen lately is anywhere between $250 to $450
a month.
A month.
Yeah.
Yeah, a month. So that can have a big impact on your payment. And then we look at those things. So then they're like, all right, I either want a condo or I want a 2-story, a ranch. I'd like to have some acreage. I do hear that a lot.
Yeah, that's a big conversation lately.
Big time, big time. So if you go that and you're looking at a first-time buyer, if they're in that more rural area, then we can start exploring USDA. Mm-hmm. USDA does have different parameters as far as qualification income-wise is concerned. But that's the reason why I ask those up front, because then I can kind of mold the situation around them and where they want to be.
Mm-hmm. So, okay, now you figured out where I want to be for the tax record or for the tax rate, and then you're finding out what type of house I want to be in to make sure that if there's any extra fees associated with that style of living, that's factored into the whole thing. Mm-hmm. Now I've told you where I want to be, what kind of house I'm looking for, then where do we go from there?
Well, let's talk about income.
Okay.
What do you do for work?
I'm a realtor.
A realtor.
Well, actually, let's back up for a second because that's a self-employed category. We'll come back. We'll come back to that a little bit different can of worms there. Let's just say that I am. I work for Amazon.
Okay.
Okay.
So a typical hourly employee.
Yep.
Unless you're management, and some of them have more salary.
Yeah. No overtime. Nothing crazy.
Right. So basically, what I'll do is I'll talk about what your hourly rate is. If it's call it $20 an hour.
Sure.
We're going to take 20 over 40 over 52 weeks. And average that in there. If there's overtime has to be consistent over a 2-year basis, and then we can utilize that to ultimately elevate where your income level is at. Most W-2 people are really easy to qualify because it's a pretty standard number. Like you said, you go into self-employment, it's a totally different ballgame. But as we look at that, that's where I'm going to base it, based on their gross income, and say their spouse or significant other is W-2 as well, and we'll do the exact same thing. They could be on $40,000, $50,000, $60,000 salary. So we're going to add those two together over the course of that 12 months, and that's the average or the gross that we're going to utilize. Between that, their debts on credit, as well as what they want their mortgage to be at, that's kind of where I base if their debt-to-income ratio is going to fly for a certain product.
Okay, so let's dumb that down so I can understand it.
Gotcha.
Right? I know you and I know this stuff.
Yeah, I was going to say, forgive me because I speak this language. I tell my clients this all the time. I speak this language every day, so thank you for doing that.
Yeah, so it's like, okay, we'll step out in front of the curtain now and kind of talk like normal layperson language here. So debt to income ratio, you make X amount per month, and then your debts equal a certain amount per month. And those debts could be your car, student loans.
Any liability that's on your credit report.
Okay, so if I'm financing a TV that I bought or a laptop that I picked up at Best Buy.
If it shows on your credit report, yeah.
So that's going to factor into what I can buy per month. And that's another reason why loan officers say and realtors say, don't go out there and buy a couch on credit before you – don't buy a couch, don't buy a car, don't buy anything on credit before you close on your house, but for the debt-to-income ratio issue.
I think we'll definitely touch on.
Yeah, so debt-to-income ratio, how much do you make? What's your debt compared to your income? And then what kind of ratios are we trying to hit? Like what, if you saw a high debt-to-income ratio that would disqualify somebody from getting a loan, what's that look like?
Oh, well, so there's several different programs.
Okay.
FHA is going to have the highest debt-to-income ratio allowance, and that's 56.9.
Okay.
So that's high.
So that is if I have 500
Call it 50% of your debt.
Yeah, so let's say I got $560 a month in debt and I make $1,000 a month. That's a 56% debt to income ratio. Now, is that 56% before I buy this house or after?
It includes it.
It includes the house.
Includes the potential mortgage payment.
So if right now my debt to income ratio is a 30% of my income, and then now I've got 26% of my income that I can spend on housing.
Then you're great.
Okay.
You're in good position.
All right.
You can get a loan with any qualification. So just to kind of cap real quick. So with USDA, we're hovering around 43%. Same with conventional products. And then FHA is going to be a little bit higher. Some of our portfolio products, we can go a little bit more. But it all depends on the automated underwriting system and what their findings are. So to touch on that really quick, we run all of our loan processes and applications through an automated underwrite. Called Desktop Underwriter, Desktop Originator, and essentially what it does is it spits out guidelines for an underwriter to go by. Based on all things considered, the strength of the file, you could get an approval in the system for a little bit higher of a ratio. So it just depends.
Gotcha.
If you got a lower credit score, you're less likely to get that higher percentage rate.
What if my debt to income ratio is high, but I got a bunch of money in the bank? Like, let's just say that I've got, I don't know, whatever you would consider a bunch of money.
Well,
does that matter? Are you going to make me put more money down on the house?
That's where it's going to.
Okay.
That's where the conversation is going to lead to, is how much we actually put down, what you're comfortable with putting down, which is another question that I do ask, typically right up front after budget, is how much are you wanting to put down?
Okay, so let's talk about that. You mentioned that was one of the myths or the misnomers about the down payment. I've got to have 20% to put down.
Well, that's typical of the rule of thumb. Over the course of our generations, our parents did it. And, anytime you put down 20%, you do not have to pay PMI. PMI is mortgage insurance on that other 10% or other 5% that you do not put down. So, with that said, like I said, we can do 3% conventional for typically reserved for first-time buyers. Those particular products do have a cap, an income cap geographically, and it's usually county to county, somewhere around that $50,000 to $65,000, maybe even $70,000 mark.
Gotcha.
For the household income. So it's kind of tight guideline there. 3.5% for FHA. That's where a typical first-time home buyer is going to fall in. 5%, I do a lot of those for first-time buyers. I did a 5% myself just because I got a better interest rate.
I mean, when the interest rates are so low, you finance as much as you can over 30 years, and then you use your cash to go make more money somewhere else. Yeah.
That's right. And that was kind of the ideology behind that. But, we can do it. We can customize it to anything. So if you come to me and say, I have $10,000 to put down, again, I'm going to take your budget. I'm going to take where you want to live. I'm going to take that $10,000 into allocation and wrap that in there.
So you've got all these ingredients, right? You've got the debt to income ratio. You've got where I want to live. You've got my money in the bank. And these are the ingredients. We're about to bake a cake with all this stuff.
I like that. I like to cook, and I looked at it as, this is the recipe for success.
And our sous chef is called the automated underwriting system.
Yeah, exactly.
Like, they're going to help me bake this cake. I'm going to put it all together. Yeah.
Yeah. And if you're lying to me, the desktop underwriter is going to find out.
Well, and that's the thing, too. It's like there's some times where I'm sure you get buyers that come in and they're like, if I tell the loan officer this, they're not going to give me the job. They're not going to give me the loan. Well, at the end of the day, it's like we ended up in a mortgage crisis in 2008 because just things were being overlooked.
Stated income, lots of stuff was being overlooked.
And to keep that from happening again and to keep the mortgage industry and the housing market from falling apart, loan officers have done a really good job, and banks and all the, the Fannies and Freddies of the world have done a good job of making sure that the loan officers are collecting accurate data so that we don't end up in a big puddle of economic disaster.
That's right. And I've seen study after study lately of people thinking, the market's going to crash because rates are so high. No, so many people that have mortgages right now have been qualified in that range for a reason. Back then, what Aaron's referencing, they were not. It was more or less, you got a job? A heartbeat?
Yeah.
We're in.
I can fog up a mirror. I can have a loan of whatever I want. So
That's right.
So you've collected all this information and everything, the ingredients to make this cake, right? This mortgage cake. Then what? I mean, I guess at that point, do I just get a pre-approval letter?
Well, yes, it can, but I always try to ask as many questions as I possibly can.
Like, are you paying child support?
100%.
That's an expense that often gets overlooked, right?
Well, that goes into the conversation of where are we at? Are you married? Or if someone comes out and they tell me that they're divorced and they're, buying their first home post-divorce, it's like that immediately rings in my head, right? I talk to them about credit. Hey, do you know what your credit score looks like? Because a lot of people will have Credit Karma or one of these different tracking apps that states, what it is to see where they're at.
Yeah.
At least gives them a snapshot. It's not always accurate.
It's a ballpark.
Ballpark, exactly. But if they come and they tell me that it's, 680 or 640 or even less, then I ask why.
So while we're on this subject right now, here's something that I didn't really understand until I was immersed in the real estate industry. Talk to me about the importance of a middle score.
Okay. So whenever you're qualifying for a mortgage, we always use the lowest middle score of each borrower. So if Aaron and I are buying a home together and he's got a 640 and I have an 810, we're using that so we're not biased to the higher credit score.
Okay. So the middle score, there's 3 credit bureaus that
That's
report, Experian, TransUnion, and Equifax. Pull all 3 credit bureaus, and then you're going to use the one that falls in the middle. I might have, what'd you say, 640, 720, and an 800. We're using the 720.
Exactly.
Right?
Exactly.
Why that's important is all 3 credit bureaus may have similar but different scores. Well, if you're close to one of the cutoffs for a conventional loan, what's the minimum conventional or ballpark?
620 to 640.
Okay.
It depends on the investor.
Don't quote them on that, but somewhere in the low 600s, right? If my credit score is a 615 middle score, and then the other score is like a 650 and the other score is like a 580, well, the middle score, even though my best credit score is above the limit, the middle score is going to disqualify me from that loan with that investor.
That's right. And 9 times out of 10, when I ask people that I'm helping rebuild credit, they come back and like, I don't understand. Credit Karma told me it's 660. I'm like, well, pulling directly from the bureaus is a totally different ballgame. That's why we say it's a snapshot or kind of an estimate of where your score is, because when we pull it straight from the bureaus, it's a totally different ballgame. It depends on when the reporting happens. It's all algorithmically based. Say that again.
Algorithmically.
There you go.
And that's a lot of syllables.
Yeah, it is.
We sound really smart when we say it, though.
I get stuck on that a lot. But anyway, so all things considered, credit is it's eighth wonder of the world sometimes.
Well, and here's another thing that I hear on credit a lot. I don't want the loan officer to pull my score because I don't want it to let my credit score go down.
That is a myth. It's a myth in the situation if you're just shopping for a mortgage.
Right.
Now, if you're out looking for a car, you're trying to buy a boat, you're opening up store credit left and right, and then you get a mortgage pulled by 3 different loan officers, yeah, it's going to have a negative impact on your score. But I will tell you, that's probably in the 10 percentile of negative impact and almost 0% if you're just shopping for a mortgage.
Yeah, so let's say, for example, my agent gives me 3 people to call. You're one of them, right? And I'm going to call all 3 of them. Hey, they're going to run me through some kind of similar process that you run me through, questions, that sort of thing. Hey, let me pull your credit to see where we sit. All 3 people pull my credit. My credit score will likely not be impacted, and if it is, it won't be major.
That's correct. I mean, you're talking maybe a 10-point swing, as long as it's all within the same 30 days.
Okay. But if I'm going out there, I go to the Harley-Davidson shop, and they pull my credit, and I do or don't buy something. I go to the boat dealer. I go to the Toyota shop or the Lamborghini dealer and all this other stuff.
The worst is car dealerships.
Yeah.
They run 3 different bureaus. Any different company that they check to see about financing is going to be another hit.
Yeah.
Sometimes you can have 10, 12 inquiries on just one pull or maybe even 2.
Yeah.
And then you go to another dealership and they do the exact same thing. Shoot over to Kohl's and get that special. All those things.
And it
add
just,
a mortgage in
all
there.
the inquiries ding your credit, but if you have a 30-day shopping window for mortgage,
yeah,
you're fine.
And the algorithms, they recognize that you're just trying to be an informed consumer and doing the best for you and your family when it comes to shopping for that particular financial.
So they saw that as a thing, and they made it kind of more favorable to the borrower. So here's a question. I get pre-approved in March. I don't find a house for, let's say I'm still shopping 90 to 120 days later. Should I? And the interest rates just went from 3.25% to 6.25%. Or where are they today? You have any idea?
A little sub 5% right now. We're about 4.875.
Get out of here. That's nice. Okay. Well, they've dropped a bit. So
over the course of the last 2-3 weeks, they really have.
But I want to make sure that before I go out there and look at this house, that everything's still copacetic. The interest rates have changed a little bit. I want to make sure that I'm still good to buy this house. What happens now? I'm 90 days later, and have you repulled my credit, or do you just ask me, hey, have you bought anything on credit lately?
So typically with my pre-approval letters, I put 60 days on there. That's when the expiration is. Nothing really expires except for the credit report. I'm able to utilize the one pull, the one credit report for 120 days. Typically 90, we're going to need a refresh because of the 30-day time and process. An underwriter is going to want to see a fresh report. If you're not reporting since March, we're going to want to know if you made your payments on time. You know what I mean? What's your score? What has your score done? I always tell people, if you change your job, if something along those lines happens, you buy a boat, you buy this, then we need to refresh just to make sure things are still in line. But otherwise, if nothing's changed, you just haven't found a home, then we'll revisit that pool around 90 to 120 days. And as long as everything looks on the up and up, then we'll just continue that process.
Got it. So what else needs to happen? So my agent said, hey, go call Charlie and don't come talk to me again until you have a pre-approval letter. So what needs to happen? Obviously, you're asking questions left and right to make sure that you've got all the accurate information that you can. The reason that you do that is so that this buyer doesn't go out there and get all excited, and then they go make an offer on a house, and you were missing a piece of the cake.
Yep.
And then now they've got to back out of this deal because they no longer qualify for this thing.
That's right. And then you waste the agent's time, you waste everyone's time, you waste even my own time in that process.
And their emotions. They walk their kids through this house.
Oh, yeah.
So that you don't want them to get so involved in the process and not have all the pieces of the puzzle. And guys, I've gone through the mortgage process more times than I even want to admit. And it's not easy because you're gathering all these documents and you're providing all this information, but it's so important to give the information. These are all ingredients to a bigger piece of the puzzle. Yes, you know you're good for it. You know you'll make the payment. But at the end of the day, the loan officer really cares to make sure that you don't go out there and make an offer on a house and you're going to end up having to tell your kids that they can't have that bedroom.
That's right. That's right. And that is a very important piece. So like I said, normally if someone hasn't found a home yet or comes to me and is just a general, hey, want to get the process started type buyer, then I'll issue them a TBD or to be determined type pre-approval letter. Mm-hmm. What I really like to do is I like to make it specific to the address. Okay, they're approved. I'll tell Aaron, hey, they're approved, and he calls me up, 2 weeks later, hey, they want to go look at 123 Main Street. All right, cool. I'll circle back, look up 123 Main Street. He gives me the price, talk to the borrowers on how much they want to put down, look up the tax bracket. Here's your estimated payment. Are you comfortable with that? All right, cool. So then I'll reissue a specific approval letter that states 123 Main Street on there. So when he presents the offer, the seller knows this borrower is approved to buy this home.
Yeah.
Straight up.
And so flip that around. If you're a home buyer in today's market and you are about to make an offer on a house, it's almost like you're going on a job interview. In today's world, you're still seeing multiple offers, especially around that average price point, sub 300 kind of thing in greater Cincinnati. As a listing agent, if your buyer's agent sends me the pre-approval letter with the offer and it has the address of our listing on the pre-approval letter, I already know that the loan officer has looked at the tax records on this house. They've looked at the taxes. They've evaluated that against your credit score. And if the buyer's agent copies the lender on the email where the offer gets sent over, I now know that the lender is aware that an offer has been made. The lender can chime in and say, hey, thanks for taking time to consider the offer. I've reviewed all 3 credit bureaus. Buyer's good as gold. We've got a great buyer here. Thanks for giving their offer some consideration.
That's right. It goes a long way.
It goes a long way because the listing agent, what do they want? They want a secure deal for their client. They want to make sure that not only is it the best thing for my client, it's not going to fall apart.
Absolutely. And as loan officers, we get that a lot.
I'm sure.
How strong is this borrower? And I've got a buyer right now that's putting down 50% because they sold their property. And I get calls almost weekly, like, is everything good? Is everything good? Yeah, we're great. We're good. So I can understand the uncertainty as far as a seller in this market. And, things are changing. I feel like it's shifting a little bit more towards a buyer. That's another conversation. But, it's more to put everyone at ease. And if you do your diligence up front and make sure that all the right questions are asked and you have all the paper in front of you, and at that point in time, we pretty much know that the buyer's ironclad and something drastic has to happen for it not to be.
And I'll let you give a little real estate advice here. If you're selling your house and the buyer makes an offer and does not have a pre-approval letter, are you going to give that offer the time of the day?
No.
It's like, how am I supposed to know you're good for this money? Like, you're not just carrying around enough, cash to buy this thing.
Yeah, I mean, you know the person, that's one thing, but even if I knew them, it's like, okay, so are you paying cash? Like, let's see the cash, or let me see some type of record.
Yeah.
That says that we're
no,
good.
Handshake agreements are long past, and people's, some people may feel like, oh, I can make that payment, I'm good for it, but the people who are making the loan on the house, they need to make sure that they're going to approve you first. And that's
right.
why you got to have a pre-approval letter.
I had several clients last year that went ahead and made offers, and they would come back to me in a scramble, like, hey, I need to get an approval letter. And then I would actually go through the approval process, and they're like, wait a minute.
That is,
and it's like, that's why you come to us first.
That's the equivalent of firing the arrow and running out in front of the arrow to try to put the target up.
yeah, cart before the horse, if you will, for sure.
So let's backtrack for a second because we punted a topic that was self-employed buyers.
Absolutely.
Right. I'm self-employed. I don't get a W-2 from an employer. I get a 1099. So I don't file taxes the same way.
Absolutely.
So talk to me about how that differs and what you're looking for with a self-employed borrower.
Well, that's kind of to preface with the W-2 borrowers, typically, well, with all borrowers, really, we want to see a 2-year income snapshot. Not snapshot. We want to see a 2-year income
paper trail
of all the things that you have done. So if you change different jobs, we're going to want to know that. because if you go from one job to another, sometimes it may disqualify you from a mortgage depending on what industry you're in. If you go from management to management, that's a different story. What if you go from sales to restaurant management? Totally different ballgame, and that may disqualify you from being under that 2-year longevity cap. As far as a self-employed borrower, it's the exact same thing. We have to have 2 years record of tax returns, both for the business and for the borrower, unless they're one and the same, that details your record and what you do. Because as self-employed borrowers, you guys write off a lot of stuff. And
yeah, I mean, you've got employees, you've got marketing expenses, you've got fuel, you've got all that stuff.
Yeah, and the biggest thing about that is most people that own businesses, they make a good amount of money, and after their write-off, their actual bottom dollar, their net profit is what we go by.
Yeah.
Where we go off gross when it comes to W-2 employees, we go off net when it comes to the self-employed
So
borrowers.
obviously tax records are going to be the gold standard of what you're looking at, but do you also ask for a profit and loss statement from a self-employed borrower?
That's correct. So you haven't filed 2022's taxes yet, or 2021's taxes yet.
Right.
Here we are. Well, you should by now.
Right.
But say you're earlier in 2022, which I think that was a situation that you were in, right?
Yeah, I think we were after the tax deadline.
Yeah.
We got an extension, and then basically you just used my 2021's profit and loss statement instead of the tax return.
Yeah, and Aaron had plenty of tax returns from the years prior to back that up. Yeah. So in that situation, yes, you can file an extension if you get past that April 15th tax date deadline.
It's actually before that. Self-employed, the 1099 self-employed, I think your tax deadline is before, or maybe that's business filings for your LLC.
Great question.
I think it's the LLC filings are before. Personal is April 15th. My bad. Talk to Chris Rogers.
I was going to say, that's a question for Chris.
Yeah, he's probably shaking his head like, dude, you butchered that.
You guys. These guys.
Look at these guys.
No, but yeah, profit and loss is really kind of what details everything. The proof's in the pudding. If it's hey, here's what I made, here's net expense, or here's just advertising, this, that, and the other, then we're going to want to ask more questions. But on Aaron's P&L, it was very detailed. It showed where every dollar was allocated to, and ultimately it matched a draft that Chris had put together for you. Mm-hmm. So we submitted that draft as well as the P&L, even though he hadn't filed yet, and that's the income that we were able to utilize.
So here's the thing. Every year, it seems like there's more and more people who are earning an income outside of their daily activities, right? So this passive income or a side hustle, Color Street Nails, Neora Health Products, farming. Yeah, you're earning rent off of rental properties, or you're earning rent or earning some sort of income outside of my self-employed status.
That's right.
How does that play in? Can I use that income?
You definitely can.
Do I need 2 years of that income to show?
do.
Okay.
You do.
So if I just started, like let's say I bought a rental property in 2022, and I'm earning, I don't know, let's just say $1,400 a month off this rental property.
Rental properties are a little different. You don't necessarily need 2 years there. You just have to have it filed on one tax return.
Gotcha. Okay, even better.
And under lease.
But if I'm selling Color Street Nails and I'm making, I don't know, $1,000 a month or whatever, which would help my debt to income ratio, I need 2 years of tax returns showing that Color Street paid me 2 years in a row, and you're going to use the average of the income on that.
That's correct.
Okay,
That's
cool.
correct. So again, it just all comes down to net. So if you're making $1,000 a month, but yet your expenses are, $1,200, and you're showing a $200 loss, we have to factor in that $200 loss.
Well, that hits you the wrong way.
And it factors against your normal day to day. So I get that a lot with farming. So we have a lot of rural customers with the bank that have big farmland. So what they'll do is most people take a loss in farming, right? Mm-hmm. If you're a plumber that's making $200,000 a year, your net say 90, but you have a $50,000 loss on your farming income. Guess what? Now you're only making 40.
Gotcha.
So it has a big factor. It's a big to do, and you have to really go through those returns. And some of them can get complicated. Believe me, I've called accountants all the time. Say, hey, what is this? And how can I allocate this? And do we actually need this? Now, I have another borrower that the wife is the only one on the loan with the mother-in-law, and the mister took a farm loss, so we didn't have to use the mister's farm loss because he's not actually on this loan. He's only on title. So there's ins and outs and ways around it, but the rule of thumb is if you're taking a loss, it's going against your total income.
Yeah. So I guess the lesson to be learned there is if you are self-employed and you're planning to buy property or buy some sort of real estate using a mortgage in the near future, let's call it 2 years, right? Don't report such a heavy loss for a tax write-off. Report your income properly, pay the taxes on it so that you can actually borrow money the right way.
That's correct. And, I've had a couple of friends and clients come to me that are new into business entities. And, one in particular is a contractor, another one's a local restaurant around here. And I sat down with them from the get-go and said, hey, this is what you need to look at. This is what your idea is of where you want to claim, but here's where you need to be in order to buy, a $400,000 home or wherever you want to be. So kind of just, it's like the mortgage application. I'll sit with them and go through their taxes and say, okay, if you want to be here, this is how much money you're going to need to claim. So keep that in mind when you have to stroke that check to Uncle Sam at the end of the year or each quarter.
Gotcha. All right, so that's a lot to chew on.
A lot. Self-employment it's a phone call. We can sit and talk about it all day long, but it really just depends on what your profession is, how much you're writing off, and what your time frame is.
Well,
where you want to be.
And I think the complexity of this conversation speaks to why when we get calls from people who I want to see your listing, or I'm thinking about buying a house and I saw this thing on the internet and I want to go take a look at it right now. Mm-hmm. You can see why it's so important that agents always say, hey, why don't you go ahead and give my lender a call? Let's get a pre-approval letter and get this process started so that we can get going, because there's so many factors that play into it.
That's right. We don't just quote rates.
Yeah. I mean, we don't want to put the cart before the horse, so to speak, and go out there, because what's going to happen, and I've seen this happen, you go out there, you take a look at a house, you fall in love with it, you brought your mom and dad and your kids, they really like it, it's got the pool that you've been wanting, and then they call you and you're like, and not just you, any loan officer, they call them and they start to qualify them, and then it's just, I hate to inform you, but this thing that's been on your credit for a little while, it needs to come off, or you may not have
disqualifying you in general.
You may not have even known about it, and then you, instead of putting the horse first, then you would have already known about this stuff. You've been ready to go. You could have wrote an offer on that house tonight. That's right. Instead, somebody else is going to be buying that house because they were prepared. They had a pre-approval letter.
That's right. That's right. Yeah, and that just goes to the importance and why all agents anymore these days aren't going to waste any time without those letters.
The market is so fast right now. It's still, I mean, it's, we had a shift in the interest rates, right? But the market is still so fast that getting in the car, driving to the house, and walking through it, writing the offer, they still may already have several offers on the house. So you got to have that pre-approval letter, because if they call you on the weekend and you're like, yeah, I can get you a pre-approval letter cranked out by the end of the day today, it still may not be fast enough. Yeah, that's why you're always the first call.
It's like showing up to the gym without your shoes, man.
Yeah. yeah. You're not going to work out in high heels or dress shoes. I'm not going to say we haven't done it, but sure. I mean, it's happened. So, well, thanks for tuning in to the Real Estate Momentum Podcast. This is Charlie Vallandingham with Heritage Bank here in Northern Kentucky. Stay tuned for more on mortgage information. We're actually going to take a trip to Charlie's office, so you might see a little bit of what he does behind the scenes.